The debt ceiling is a limit imposed by Congress on the amount of debt that the U.S. federal government can borrow to fulfill its financial obligations. The debt limit does not authorize any new spending, but simply allows the U.S. to finance existing obligations that Congress has already approved. The current debt limit is $31.4 trillion, which was raised by $2.5 trillion in December 2021 after months of political deadlock and warnings from Treasury Secretary Janet Yellen that the U.S. could default on its debt if Congress did not act. The U.S. has never defaulted on its debt before, but it came close in 2011 when it reached its debt ceiling and faced a downgrade of its credit rating and a plunge in the stock market. The debt ceiling matters for the U.S. economy and the global financial system because it affects the confidence and trust that investors, creditors, and consumers have in the U.S. government's ability to manage its finances and honor its obligations. If the U.S. were to default on its debt, it could trigger a financial crisis that would disrupt the flow of money, raise interest rates, increase borrowing costs, reduce economic growth, and harm millions of Americans who rely on government programs and services. The debt ceiling also matters for the U.S. economy and the global financial system because it reflects the political polarization and dysfunction that have made it harder for Congress to agree on fiscal policies that could address the long-term challenges of rising debt and deficits, aging population, health care costs, infrastructure needs, and climate change. The debt ceiling has become a bargaining tool for lawmakers to extract concessions from their opponents or advance their ideological agendas, rather than a mechanism for fiscal responsibility and accountability.